Hey guys, Chandra Shirshad here, and this is Introduction to Options Trading. So before we begin, I would like to start with this disclaimer. I am not a certified financial advisor or an expert in these, or claim to be an expert in these areas being discussed. Um, all of this that I'm going to discuss today is something that I have learned on my own by reading a lot of articles, blogs, and a lot of experience trading with stocks, options, and a little bit of bonds and money market account and stuff like that. This video is for purely for educational purposes, and you are responsible for any gains or losses that you incur based on any trades you place based on this session. With that, let's begin. I would like to say that options are very powerful. But options are less risky than stocks. Yes, less risky. This is something you're hearing the uh, contradiction from what many others have said. However, that is true only if you know what you're doing. If you know what you're doing, options are less risky. But options can be very risky, like most people have must have warned you already, and you could lose your shirt. That is, if you are reckless or you have no understanding or you don't have the full understanding of what you are doing. Before we begin, I would like to say that this session is not free. But at the same time, I don't want your money either. These organizations need our support at this time. Lava May X provides basic hygiene services to underprivileged and homeless people in US and around the world. Direct Relief. It works in US and internationally, about 80 plus countries, to equip doctors and nurses with life-saving medical resources to care for the world's most vulnerable people. Seva International. This is another great organization that specializes in disaster relief and rehabilitation. They also provide services in US, India, and several other countries. IDRF, or India Development and Relief Fund. This is another great organization working towards breaking the cycle of poverty in India, Nepal, Sri Lanka by empowering marginalized people with skills, services, and infrastructure. Please support these organizations and definitely use these option trading strategies to make a lot of money while being good. Okay, so what's the agenda for today? We'll start with some options jargon, some of the advanced strategies. We'll quickly browse through them and just to show the power of options, what all can do with this option trading. And then start, of course, with the basics, right? We all need to go to pre-K before we do the PhD. And before we part, let's look at some of the safe strategies. Um, that's something you can start using tomorrow. Okay, there are some prerequisites. So the fundamental prerequisite for this is you should know what stock trading is. You should have a good understanding of it, if not a good experience already trading stocks for quite some time, and you know what how stock trading works. That would be great. Otherwise, at least you should have a very good understanding of what stock trading is like. And of course, you should be coming here with willingness to learn and willingness to invest time. It's very important because it takes a lot of time. Because some of these, just the basic fundamentals of option trading, you need to understand because uh, there are a lot of terms, a lot of different moving parts. Um, if understanding stock is hard, I would say understanding option trading is like 10 times harder. And you require a lot of patience. Be patient. If you want to get into option trading, you need to be patient. You won't be able to master this in a few weeks or months. You got to try and try, play safe. Over a period of time, you'll get a hang of how this works. and I guarantee you, you will become good at option trading. All right, as I said, let's start with jargon. Bull call spread, bull put spread, bear call spread, bear put spread, long strangle, long straddle, reverse iron butterfly, reverse iron condor. Again, don't worry too much about all of these. These are advanced strategies. We'll get into them in the coming videos. I'll make more videos and we'll discuss all these strategies. Not all of them, but some of the key ones we can discuss, because there are a lot of strategies. There are many, many more strategies like these. And here is a big list of strategies. And you can make your own strategies too. I got this from the website optionstradings.org. If you want to go check out these strategies later, you can do so. Let's get down to the basics. So, what are options? Before we get into anything, let's discuss what are options. Options are financial instruments which are derivatives of something else. Derivatives, they're kind of derivatives. So, what is a derivative? Um, um, for example, orange juice is a derivative of oranges. Orange juice is made out of oranges, right? And similarly, grapes. I mean, wine, red wine, white wine. Some of the favorite wines that you drink is a derivative of grapes. So, if the orange price goes up and down, orange juice price also is affected in the coming weeks, right? And similarly, if grapes are, there is a harvest of grapes goes bad in Napa, wine prices go up. So similarly, options are derivatives of some other underlying asset, such as a stock, Apple stock, or an ETF, SPY, or some other ETF. So option trading is basically trading the derivatives of other financial assets such as stocks. So what is an option? Option is a contract between a buyer and a seller. So for like anything else, like every other trade that happens in the world, there has to be a buyer and there has to be a seller for a contract for a transaction to happen. So in this case, a buyer is buying an option, which is a contract. Basically, it's a contract uh, that gives the buyer a right. Okay, he's buying the right, but not obligation to either buy or sell an underlying instrument at a specified strike price prior to or on the specified date. So there are three key things here. The right, okay, we are buying the right to either sell an asset or buy an asset at a specified strike price. So this is another key thing. There is also a specified strike price and prior to a specific date, which means the contract expires after a certain number of days, or on a certain day the option is invalid. After that, the contract doesn't exist anymore. So that's the buyer gets the right. On the other hand, seller is obligated to fulfill that transaction, to sell or buy the underlying option if the buyer, of course, exercises that option. So the buyer is going to exercise his or her option if the transaction is going to be beneficial or profitable for him or her, right? So if the option buyer decides to exercise his or her option, the seller has to fulfill that transaction. So just to make it dumb it down a little bit, let's look at an example conversation that is happening between a buyer and a seller. A buyer says, I want to buy 100 Apple shares from you at $300 a share on May 15th. Let's say the current price is 247 or 240, 250. Let's say it's 250 for argument's sake. So today's price is 250, and on May 15th, I'm willing to buy, the buyer says, I'm willing to buy 100 Apple shares for $300 on May 15th. And the seller says, okay, fine, that works for me. Give me a premium of $11 per share, which is 1100, because each option contract is is um, is going to option contract is for 100 stocks of the underlying asset. So yeah, so you have to give me $1100, $11 per share, and I'll sign that contract. So why is this buyer interested in paying $1,100, more than $1,100 to buy shares of Apple at $300, when he or she can go to the market and buy it at 250. The current price is 250. Why is that person trying to pay another $1,100 to buy the shares of Apple at 300, which is $50 more than the current price? Why is he or she trying to do that? Because he or she thinks, the buyer thinks, that the stock price of Apple on May 15th will be like 350 or 400. He believes that the stock is going to fly for whatever reason, whatever the belief he or she has, whatever the analysis he or she may have done. Okay, the price is going to go more than 350. Then now I have this contract which I can exercise, and I can go buy the stock at $300 and then sell it out in the market for 350 or 400, whatever it is selling it for in the market. I'll make a handsome profit, and all I have spent is $1,100. He or she can go and buy 100 options, 100 stocks of Apple, and then sell it for 350. But then the investment would be how much? 250 times 100. That's going to be $25,000. So today I can put $25,000, and on May 15th I can sell it for 350, and I can make $10,000 profit. However, I don't want to do that. I don't want to put $25,000 down. I don't even have that much. So let's say I have only $1,100. I still want to take this bet and make handsome profit uh, with this money. So the buyer says, okay, take this $1,100, and May 15th I'm going to buy from you at $25,000, at 3,000, 30,000 for, sorry. So I'll be paying you $30,000 for 100 stocks of Apple, so I can turn around and sell it for 350 or 400, whatever the current price is then. And why do you think the seller is seller dumb? Is he selling shares when he or she, when the buyer is believing that the stock is going to fly off the shelf and it's going to be 350 or 400? No, the seller has another idea. The seller thinks that, yeah, the stock is going to go up. I know Apple is doing well. It will go up to 299, but there's no chance it will go to 300. He or she doesn't believe that it's going to be 300. Either that, or the seller has another thought process. Hey, if it hits 300, I'm out. I made my profit. I'm going to sell it at 300. So I'll sell this contract and collect $1,100 premium. And on May 15th, if the stock price, I don't care whether it is 400 or 500, I'm out at 300. So I made my profit. So that's the thought process of the seller. I hope that clarifies why options are being traded here and how it works. Okay, what are options? Let's go to the next slide. Here we go. Okay, option basics. Okay, there are two types of options: call options and put options. What is a call option? Call option gives the buyer or the holder um, the right to buy the underlying asset, the right to buy. Okay, so in the case of caller, right to buy the stocks, and the short, long means buyer, short means seller. This is something that you already know through your stock trading experience. So caller, in the call, buyer has the right to buy the stock, and short buy call, seller has the obligation to sell stock. In case of put, the buyer has the right to sell the stock, and seller has the obligation to buy the stock at whatever strike price. So option allows holders to buy or sell asset at stated price within the specific time frame. I'm reiterating this because this is very important. There are three things that are important. You have the option to buy or sell an asset at a specified strike price within a specified time frame. Stated price is also known as strike price. Specified time frame is also known as expiration date. Stated price options are available at various price points. So what are all the options that you can buy? The exchanges have already made this very easy for us. They have option strike prices at various different levels. We can leverage those and buy and sell options at those strike prices. And time frame expiration dates are also available at many, many expiration dates. Most of the stocks and ETFs are available for um, on a weekly basis, weekly expiration days. Every Friday there are expiration days. Some of the ETFs, such as the Spider ETF, is has even more frequent expiration days. They have like Monday, Wednesday, Friday. Like sometimes 2 or 3 times every week they have expiration dates. So it gives you a lot of option to buy or trade options at various different strike prices and expiration dates. Let's move on to look into what are call options. Call options, as we discussed earlier, allows the buyer or the holder to buy the asset at a specific at the specified strike price. In my example of Apple, the buyer had the strike price of 300 on May 15th. So on May 15th, expiration date, on or before May 15th, the buyer had the right to exercise his option or her option to buy the asset at $300. So when you buy a call option, the maximum loss is the premium that you paid. Sorry about that. Um, in the previous example, the option premium was 1,100. The seller said, "I want $1,100, to sign this contract that you're asking me to sign." And in this example, where you see the curve here, um, the maximum loss is 200. So 200 is a premium that the buyer paid to the seller. In case of buyer, the maximum loss is 200. That's it. If the price of Apple does not go up above the 300 mark, I'm not going to make anything. That's fine. I lose my $200. However, if Apple goes up, keeps going up, I make a lot of money. So there is a this is the portion where we are actually getting back your money. So 200 is what you paid, and the strike price was 40 here. At 42, this is about 42. Should be 42, right? Yeah, 42. You will start making money. Up to between 40 and 42, you are still getting your premium back. I hope that makes sense. You may have to think a little bit about this one. Come back and visit this video again and replay this video and look at this chart and how the maximum loss is $200, and at around $42 is your break even. This is the point where you made the break even. In my previous example here, the break even here would be $311. So I'm going to buy the stock from you at $300, but the stock price has to be, but I already paid you $11 per share. So I will start making profit only if the stock price goes above $311. I hope this makes sense to you. Please feel free to revisit it. Okay, going back to this option here. Okay, so maximum loss is $200 in this case. Anything above 42, you start making money. If the price goes to 900, like it did in Tesla, it will be making a lot of money. And if you sell a call, the first thing I would like to say is don't do it unless you're covered. So we'll talk about covered selling covered calls versus selling naked calls a little bit later. Without having proper authorization from your brokerage, you can't even sell naked calls. So that's option level number 4. You have to be authorized. You have to have a lot of money, a lot of experience. Only then they will let you do sell naked calls. But in any case, even if you have that authorization, you got to be extremely careful when you sell naked calls. But I will cover more about covered calls and naked calls a little bit later. But when you're selling calls, you need to be extremely careful. Um, Here, it's exact opposite of it. The profit is the profit you're going to make is $200. The premium that you're collecting. That's it. That's the maximum you can make. However, you can lose your shirt here. If the price of the stock goes up, you are going to either turn in and give if you have 100 shares of Apple, you just turn around and give that to the buyer, or you're going to buy at the current price in the market and give it to the buyer. So max profit is $200, max loss is unlimited if you are a call seller. So when would you buy a call? If you believe that the asset is going to go up, you want to buy call options. Here is the real example of call options. Something I took from Yahoo Finance. It provides a good way of showing things here. So this is example of a Friday, like a 2 or 3 weeks ago. The Friday closing price was $247.74. Apple closed at that, and here are the pricing for May 15th. So May 15th, with the strike price of 245, the last traded price was $23.40. And for about, if you want to buy a strike price of 265, you have to pay a premium of $13.50. 270, you would pay something like $11.60. So what is the shading here? The blue shaded and white shaded areas. The blue shaded areas are in the money. We'll talk about in the money a little bit later, but as you can see that the price of the asset is lower than the strike price is lower than the current value of the current price of the asset. So if the strike price is below the current closing price or current market price, they are called in the money. And anything outside of the above the strike price, above the trading current price of the asset, is outside the money, out the money. Okay, going to the next slide here. Okay, all right. Option pricing. So who determines how much? How do you know that no, it should be $23 versus $28 here? How is that determined? So option pricing are based on the implied volatility of the stock, underlying stock. So volatility is basically how much of fluctuation that is happening in the stock. If the stock is moving up and down really rapidly, that means it's a high volatile stock. The volatility is high, option price is going to be higher. So for example, Tesla has been moving up and down really crazy. So the option prices of Tesla is going to be much higher than something like Johnson and Johnson, which may not be trading, that the 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 up and down may not be that much. It's not very volatile. So option prices will be lower. So here is an example of Pepsi and UNP here. Um, they're both about the same price here, 102, 103. Um, but if you look at the call price, 37 days to expiration. Uh, Expiration date is 37 more days are there to expiration. 105 call price. Pepsi is going at 80 cents, whereas UNP is going at $2.72. And put price, $100 put price, $1.17 versus $1.92. The implied volatility of Pepsi is 16 point something, and UNP is 30, almost 31. All right, put options. So what are put options? Put options are pretty much opposite of call options. So you are betting that the underlying asset is going to go down. So here, the put option. Sorry about that. Yeah, here we go. Okay, here the put option, the buyer or the holder of the option um, has the right to sell the asset to you, to the seller. Okay, yeah, he's buying the right to sell the option, so sell the underlying asset. So when you want to sell, let's say you have 100 stocks of Apple, you want to sell it, then you sell the option. Okay, when you sell the option, you are the seller. And when you buy the option, you're actually um, saying that, okay, Apple price is going to go down. Let me buy a put option, and it goes down. I'll make money. So the maximum loss, okay, the maximum loss of a put option is the premium that you pay to the seller. Okay, in this case, $200. Okay, you pay the premium of $200. Apple is going to go down, or whatever this in this example, uh, it's going to go down from $40. The current price is 40. It's going to go down to 30 or 20 or 10, and and I'm going to pay a premium of $200. So the maximum loss is $200, and the profit potential is unlimited. as to, it's not quite unlimited until the price hits zero. I don't think it can go below zero. Can any asset go below zero? No, probably not. Okay, you'll make the maximum profit is hit um, when the underlying asset goes down to zero. Um, when do you sell a put? Okay, and first of all, I would say don't do it unless it is cash secured. Okay, you want to sell a put um, basically when you want to acquire. Okay, I want to sell a put, which means the buyer has the right to sell it to you for a certain price. So if he or she is going to be profitable, he's going to assign you those stocks. So if you should have enough cash in your account, if you have enough cash in your account and you are willing to buy that underlying asset for that particular strike price, go ahead and do it. Otherwise, you will be called margin call. It's called margin call. It's a scary margin call. Many people get that call when they don't have enough money in their account and they do crazy uh, option trading. They um, they get a call from the brokerage account saying that, hey, you're out of your, all the money in your account is gone, and you owe your, like, we are using your margin and you're gone below the margin as well, and now you need to deposit $100,000 in your account or $50,000 in your account or anything crazy like that, and you'll be like, what the hell happened? So be careful when you're selling a put or a call, and make sure that you have enough securities or enough cash in your account. um, So selling a put is exact opposite of buying a put. So when you buy a put, you get the maximum loss is 200. Here, the maximum profit is 200. When you sell a put, maximum profit is $200. But you still do that. You still get to do that. I'll tell you. When it makes sense to sell put. Um, it's one of the it's one of the safe strategies actually to sell puts. But I'll cover that in the coming slides. So you sell put, when you sell puts, the maximum profit is $200. And the maximum loss is, the stock price of the underlying stock is going down to zero. So be careful there. Um, so buy puts, if you believe the asset is going to go down. If you think Apple is going to go down, then go ahead and buy a put. Of course, you should know how much it's going to go down, and how much by when. Here is a real example of put options. Again, same Friday closing price 2 or 3 weeks ago was 247, and the May 15, 2020 put prices are here. So again, as you can see here, the shaded thing has reversed. Earlier, we saw that the top portion was shaded with blue, and now the bottom portion is shaded blue, and the top portion is white. That's because we are buying the right to sell. So anything higher than 247 is in the money. Anything below 247 is out the money. As you can see, out the money, as you go more and more outside, the more and more lower than the current price, it gets cheaper and cheaper here. It's like, as you go in deeper into the money, it gets more and more expensive. Okay, right. In the money explained. In the money is a term that refers to an option that possesses intrinsic value. Let's go back up here. So since the stock price is 247, you have the right to sell, right? Let's say I have bought the option for with a strike price of 250. This one already has intrinsic value of $2.26, right? So if I want to exercise this one, if I exercise this one right now, I have, okay, I'm going to buy it for 250. The guy says, okay, sure, have it. Um, the current market price is only this much, right? So I already have $2.26 um, intrinsic value in there. So that's why we are saying that this is in the money. Going down to more details, and in the money call option means option holder has an opportunity to buy the security below the current market price, and in the money put option means option holder can sell the security above its current market. So there is already some intrinsic value built into it. So why would you do in the money options? In the money options provide a lot of opportunities. So especially when you want to hedge your bets, many option spread strategies involve in the money option trading. Okay, option spreads. What are option spreads? Option spreads are strategies that involve buying and selling of different options. So We'll get these are advanced strategies that we touched upon in the beginning of this session. So, but we'll get into those later. So, an option spread is when you buy or sell multiple options, two or more options of the same underlying asset simultaneously. So that's when spread happens. Right? Going on here. Okay. Now, before we part, let's look at some of the safe strategies. Even though I call these safe strategies, I would still these like any other trading, stock trading, or anything that in, whenever you're talking about of trading stocks or options, there is always a level of risk involved in there. So please do this only with the money that you can afford to lose. That's a golden statement that that is floating around, as told by many people, right? Okay. So one of the safe strategies is to buy calls. Okay. Why buy calls is a safe strategy? Because the maximum loss is known. If you buy a call option for $200, you know that that's all you're going to lose. If you get your direction wrong, if you think that the price of Apple is going to go to 300 and you put $1,100 down there, the maximum loss is $1,100. You're not going to lose more than that, and you know that upfront because you are paying that upfront. Once you pay that $1,100, that's all you can lose. Okay, and the profit potential is unlimited. The Apple price can go $3,000 or $10,000. That would be great, awesome. You'll make a hell of a lot of money, um, but the loss is limited to $1,100. Okay, so pretty safe, but nonetheless, people do get burnt there as well. Why do they get burnt? Because they are super greedy. They say, okay, I'm sure Apple is going to go down to at least 350, if not 400, and I'm going to buy like 10, 15, 20 um, call options. When they do that, 1,100 times 10, let's say they buy 10 options, they are investing $11,000, and then the Apple price does not go up, then they lost their entire $11,000. And there are some good stories as well where Apple goes to 400 and they made a lot of money. But nonetheless, speculation. You are the judge, but at least you know that how much you are going to lose upfront. So buy calls, same thing, same exact thing. Buy puts. When you buy puts, you know how much you're going to lose. So if you're betting that Apple is going to go out to 200 and you're going to pay $300 for your bet, the max loss is $200. But then if Apple actually goes down before that strike price, you're going to make a lot of money. So these are pretty safe with known maximum loss that you're going to make is known. These two other things which I actually had mentioned earlier is to selling calls and puts. They are pretty risky, and I actually mentioned that we shouldn't be doing that normally. However, we should be doing those when we are covered. When we are covered, by that I mean when you have, let's say, selling covered calls, you have 100 Apple stocks, and you are willing to sell them at $300. You're willing to sell them. You're going to put a limit order anyway. So Apple is trading at 247. You're going to put a limit order. Good, good for 60 days. The order is good for 60. Next 60 days, Apple goes to 300. I'm out of it. You're going to sell it for 300 anyway. That's when you would use this strategy. You can actually generate some more cash than $300 than selling for $300. So you sell a covered call option, just like just sell a option, but you ought to have 100 options, 100 stocks of Apple. You sell a covered call for 300. May 15th, you're going to get $1,100, and by May 15th, Apple goes to 305, 310. You sold it. You got your $300, which we are going to do limit order anyway. Plus, you got $1,100 of premium. Awesome. So you actually sold the stock for 311, not for 300. And the other thing you can use this for, let's say you don't really want to sell the Apple stocks, but you know that you somehow you believe that Apple is not going to go to 350. Okay, Apple will go to 300, but it will not go to 350. And you can actually sell calls of Apple for 350 or 320. It's not going to do 320. It's only going to go up to maximum 300. So sell the covered call for 320. You're going to get very little premium, but something, right? It's not going to go to 320 anyway, but you're going to get like $500 or $300 maybe. So you can generate some income by selling covered calls. But when you do this one, uh, do know that if the Apple stock price does go to 320, you sell that option. You're going to lose those 100 stocks of Apple. And there will be tax implications as well. You didn't intend to sell them. You wanted to hold on for at least 1 year, but then you ended up selling them at 320. So be careful when you do covered calls, selling covered calls as well. Cash secured put selling. So sometimes you want to buy an asset. So let's say I want to buy um, Apple. The current price is 247 or 250. It's running around 250, 245 to 250. But I'm willing to buy Apple 100 stocks of Apple at say 220, and I'm going to put a limit order anyway. So for the next 60 days, I have a limit order. Buy 100 Apple stocks for 220. So it's just going to sit there and do nothing. And when the Apple stock comes to 220, you it'll go and buy. The brokerage firm will go buy that excess, will execute that order and give you 100 stocks of Apple. But instead of doing that, you can sell a put. You should have, of course, you should have the money to buy 100 Apple stocks. So that is the cash secured part of it. So sell a put for 220. You'll probably get a premium of, let's say, 500, 700, whatever that may be. So collect that premium and then you sit back and relax. If the Apple stock goes down to 220 or below, you get the you got to keep the premium that you received, as well as you bought the stock for 220. um, the other thing you can do is similar to selling covered calls. You can generate income. So you say that, oh, this Apple stock is not going to go to 200. It can go down to 220, but it's not going to go to 200. If it goes to 200, I'll buy it anyway. So then you can say that, okay, I'll sell some covered calls, cash secured put, put. I'll sell some cash secured puts. So if it goes down to 200, I'll get assigned. Otherwise, I'm going to generate some income. I'll get $200 to $300. So it's another way of generating income in a slow manner. But beware, you might get assigned. All right. So how do we? I would like to give you some gift of $1 million. So like anything, you need some practice. So if you want to practice, um, go ahead and get an account on investopedia.com/simulator, where you will get $1 million of paper money or fake money, where you can do all these kind of trading, you know, sell options, put option, buy options, and all that, and see how that works for you. So it's not real money, so you can play, can lose, but you learn a lot from there, and then come back and do it with the real money. But be extremely careful when you do it with the real money, of course. All right, with that, I say good luck. I hope this presentation was very useful for you. Um, Again, needless to say, options are very powerful, can be risky, can be very safe. So happy options trading. And don't forget to support these organizations. Thank you. Until next time, so long.